Putting it simply, the difference between assets and liabilities is a fundamental concept in the world of finance. This distinction is of utmost importance for anyone looking to build wealth and financial security. Assets are those financial components that contribute positively to your net worth, while liabilities are the financial elements that detract from it. In this comprehensive guide, we'll delve deeper into understanding assets and liabilities and explore strategies to maximize the former and minimize the latter. The difference between assets and liabilities is often a point of confusion for many people, particularly those who are new to financial matters. To provide clarity, let's start by establishing a clear definition of an asset. An asset is any resource that can be harnessed to generate value, most commonly in the form of money. This definition includes a wide array of items, ranging from physical possessions like real estate and vehicles to intangible resources like stocks, bonds, and intellectual property. The key is that assets have the potential to appreciate over time and contribute positively to your financial well-being. On the other hand, liabilities are essentially financial obligations that drain your resources and reduce your net worth. These typically involve payments that must be made regularly, such as mortgages, car loans, credit card debt, and other forms of borrowing. While these liabilities may have been incurred for various reasons, including purchasing a home or financing a vehicle, they represent a continuous drain on your financial resources and can impede your ability to accumulate wealth. Let's take the example of a house to illustrate the concept of assets and liabilities. Is a house an asset? This is a common question, and the answer depends on how you use it. If you purchase a home with the intention of residing in it indefinitely and have no plans to sell it or generate income from it, the house can be viewed as a liability. Owning a home comes with various expenses, including mortgage payments, property taxes, maintenance costs, and insurance. These ongoing financial commitments can quickly erode your financial resources and represent a significant liability. Conversely, if you acquire a property with the intention of selling it for a profit or using it as an income-generating asset, it becomes a genuine asset. The key difference here is the property's potential to appreciate in value and generate income beyond the expenses associated with it. Another commonly debated topic is whether a car can be considered an asset. Vehicles are notorious for depreciating rapidly, and many argue that they are liabilities rather than assets. This is a valid point, especially when it comes to everyday vehicles that lose value quickly after purchase. However, some people believe that if you plan to sell the car later at a higher price or use it for income-generating purposes, it can be classified as an asset. In my perspective, a good asset should not only retain its value but also have the potential to generate profit. A car that rapidly depreciates, regardless of whether you sell it shortly after purchase or a few years down the line, doesn't fit this criteria. The cost of ownership, including depreciation, maintenance, and insurance, typically exceeds any potential profit from selling it. Of course, there are exceptions to this general rule. Vintage or collectible cars, for instance, can appreciate in value over time, making them potential assets. But such cases are rare, and for the average person, a car is often more of a financial liability than an asset. Now, let's explore the differentiation between tangible and intangible assets. Tangible assets are those you can physically touch and interact with. They encompass property, land, equipment, cash, and inventory, among others. These assets have a concrete, physical presence. In contrast, intangible assets lack a physical form and include items such as patents, copyrights, trademarks, and intellectual property. Intangible assets derive their value from legal rights and intellectual prowess rather than physical attributes. When it comes to the classification of assets, another important distinction lies between financial assets and real assets. People often conflate these categories, assuming that they are one and the same. However, they have distinct characteristics and implications for your financial well-being. Real assets are tangible assets that have intrinsic value. Intrinsic value is the fundamental value of an asset, unaffected by external market influences. This intrinsic value forms the basis for assessing the worth of real assets, making them less susceptible to market fluctuations. Real assets encompass properties, land, and physical commodities like gold and silver. The value of these assets is determined by their inherent properties, location, and utility, rather than external factors such as market demand or speculation. Financial assets, on the other hand, derive their value from contractual claims or ownership rights. They are typically more liquid and easier to trade in financial markets. Examples of financial assets include stocks, bonds, and derivatives. The value of these assets is influenced by market forces, such as supply and demand, economic conditions, and investor sentiment. It's worth noting that financial assets are subject to market volatility, which can result in fluctuations in their value. This is why investors like Warren Buffett often emphasize the importance of determining the intrinsic value of a company when investing in stocks. By assessing whether a stock's market price is higher or lower than its intrinsic value, you can make more informed investment decisions. The crucial aspect to consider is the role that financial assets play in your overall financial strategy. They are easier to convert into cash when needed, allowing you to respond swiftly to market changes. Real assets, in contrast, may require more time and effort to sell or liquidate. Now, let's shift our focus to one of the most popular and accessible financial assets: stocks. Stocks represent ownership shares in a company, and understanding how they work can open up opportunities for financial growth and security. When you purchase a stock, you essentially acquire a fractional ownership stake in that company. Think of it as owning a small piece of a larger puzzle. The more shares you own, the greater your ownership in the company, and the more significant your influence over certain company decisions. There are two primary methods for making money with stocks, and understanding them is vital for successful investing. The first method, and perhaps the most familiar, is capital gains. Capital gains involve buying a stock and holding onto it until its market price appreciates. Once the stock's price has increased, you can sell it for a profit. For example, if you purchase a stock for $50 and sell it later for $70, you've realized a capital gain of $20. However, it's essential to recognize that stock prices are not guaranteed to rise continually. They fluctuate in response to various factors, including market demand, economic conditions, and company performance. If you believe a stock will become more valuable in the future, buying it at a lower price can result in a capital gain when you sell it at a higher price. But there is also risk involved. If your prediction is incorrect and the stock's price declines, you could incur a capital loss. Many view stock investing as a form of gambling, but with careful research and evaluation of the companies you invest in, you can significantly increase your chances of making a profit. The second way to make money with stocks is through dividends. Dividends represent a portion of a company's profits that is distributed to its shareholders. These payments are typically issued on a regular basis, such as annually, quarterly, or semi-annually. The amount you receive is directly related to your ownership stake in the company, and it's a way for the company to share its financial success with its shareholders. Think of dividends as your reward for being a loyal shareholder. It's akin to receiving a share of the company's earnings, based on your ownership. Using our fractional ownership example, if you own 1% of a company's shares, you will receive 1% of the total dividends paid out by the company. These dividends can provide a steady income stream and are particularly attractive to income-focused investors, such as retirees or those looking for passive income. It's important to note that not all stocks pay dividends. Some companies reinvest their profits back into the business rather than distributing them to shareholders. Whether a stock pays dividends or not is a key consideration when building a diversified portfolio to meet your financial goals. To acquire stocks, you'll typically need to open an investment account through an online stockbroker or, if your bank offers such services, you can choose the traditional route. Fees and regulations apply to these transactions, and it's essential to understand the terms and conditions associated with your chosen method of acquiring stocks. Additionally, it's important to do your research and make informed decisions when selecting the stocks that align with your financial goals and risk tolerance. Moving beyond stocks, let's explore another valuable asset category: real estate. Real estate, particularly property ownership, is often viewed as a path to financial stability and wealth. However, not all forms of real estate can be classified as assets. The common belief is that owning a home for personal residence equates to an asset. However, this is not always the case. If your intention is to live in the home for the foreseeable future and you do not plan to sell it or generate income from it, the property is best categorized as an expense rather than an asset. Owning a home comes with various ongoing costs, including mortgage payments, property taxes, maintenance, and insurance. These financial commitments represent a continual drain on your resources and can be considered a liability. Conversely, real estate investors take a different approach. They seek underpriced or undervalued properties with the intent of reselling them for a profit or generating rental income. In this scenario, real estate transforms into a genuine asset. These investors actively work to increase the value of the property through renovations, enhancements, or capitalizing on market trends. The property becomes a means to generate income and is, therefore, an asset in their investment portfolio. Real estate investments require a specific skill set and knowledge, and they come with inherent risks. It's essential to conduct thorough due diligence and possibly seek guidance from professionals before venturing into real estate as an investment. For those who do not have the expertise or the resources to directly invest in real estate investment trusts, REITs, offer an alternative. REITs are companies that pool funds from numerous investors to invest in various forms of real estate. By investing in REITs, you indirectly own a share of real estate assets without the responsibilities of direct ownership. These investments often provide diversification, liquidity, and the potential for regular dividend payments. Another valuable asset that isn't often discussed in financial terms is knowledge. Knowledge is an intangible asset that can be leveraged to create opportunities and financial gain. Think of knowledge as a tool you can use to build and expand your wealth. For example, if you possess a valuable skill or expertise, you can offer your services in exchange for payment. This knowledge-based income stream can grow over time, making your knowledge a valuable asset. If you own a business, your knowledge can be shared with your employees, contributing to the company's success. The return on investment in knowledge is measurable, as you can calculate how much you earn from the application of your expertise or skill. In the modern world, knowledge is increasingly accessible through education, training, and online resources. As an individual, you have the opportunity to become an asset by acquiring valuable knowledge that is in demand. Many entrepreneurs and businesses are willing to pay for specific skills, whether it's digital marketing, coding, content creation, or financial expertise. In conclusion, understanding the distinction between assets and liabilities is fundamental to financial success. By identifying and cultivating assets that have the potential to appreciate, generate income, or increase your financial worth, you can set yourself on the path to financial security and wealth. Whether it's through investments like stocks or real estate, or by capitalizing on your knowledge and skills, the right approach to assets can significantly impact your financial future. The key to effective financial management is to continually educate yourself and make informed decisions about your assets and liabilities. Remember that every financial choice you make can have a long-term impact on your financial well-being. So, take the time to assess your financial situation, identify opportunities to build assets, and ensure your money works for you. With knowledge and a strategic approach, you can make the most of your financial resources and build a more secure future for yourself and your family. If you are looking for ways to make more money, I recommend you watch this video next. Do not hesitate to share this video with friends, subscribe to the channel, and share your thoughts on today's video. Thanks for watching, and I'll see you in the next one.